In this lessons episode, explore how founders can navigate the complex realities of fundraising at every stage. Discover why timing a raise depends on traction, credibility, and vision rather than rigid milestones. Understand how simplicity and clarity in a pitch deck build investor trust, and uncover key best practices that separate successful startup storytelling from costly fundraising mistakes. And do you think that founders should go and get those no's ASAP before the pre-revenue, or do you think that you should wait till you have revenue to actually go out to raise that, even Series A?
Well, yeah, Series A and seed, and DocSend has research on all these different stages. We've tried to quantify it because, and the research that DocSend does on this stuff is just of interest to me personally, because when I was starting Pursuit and I was asking for advice, I got just so much anecdotal advice. I'm like, this is what I did and it worked, so do that, or this is what I did and it didn't work, so don't do that. And I was like, has anyone done any kind of research on this? And when I went to conferences, it's usually like older venture capitalists who pontificate about what they like to see in a company, and if you're going to get me to invest, here's my investment philosophy. And it's kind of more geared towards them pontificating on why they're so brilliant and successful, which, as an entrepreneur in the audience being like, I just need your money, is not necessarily super helpful to me. And I'm like, I don't even care if it's your money, I just need someone's money, I'm trying to fundraise here. So for the DocSend research, we try to come at it from the entrepreneur's perspective, and so we break out how Series A is different than Series Seed, then pre-seed, and so on. Even venture capital fundraising is something we have enough data on to have some interesting takeaways. And it's not so much what should you do, it's just common takeaways from all the companies that we can get to participate in this research around what are common factors of success and failure. And so the narrative that a company tells really depends on what they're doing. And so it's kind of hard to give specifics, which is kind of annoying. And to your question around is it better to raise pre-revenue or pre-launch, or the answer is usually it depends, because that's what I mean by take stock of what you have to show for yourself kind of as evidence. If you're a second time founder, awesome. If you've got a really great track record and career as a Google machine learning engineer, or you've gone to name brand schools, these are all things that can count in your favor. If you're oh my God, I'm a nobody, I'm non-technical, I have nothing of note on my resume, that a venture capitalist would be like, oh, well, at least that's a, impressive something or other, then yeah, maybe you need to have a little bit more traction or revenue or something to show for it. Maybe you have to be a little bit scrappier. And so the answer is it depends. And so that's why, it's just good to get advice from folks, and the nuance of your business. And typically it's easiest if you can get advice from if you're raising a seed round, Series A investors, because they'll be more honest with you, hoping that you'll come back to them later and they'll have an advantage in funding your Series A, as opposed to getting advice from seed investors when you're looking for seed round. They're just looking at you as do I invest or not? So get that advice. But specifically to, do I raise before revenue or after revenue, or before launch or after launch? The common trade-off is that it's always easier to sell the vision before launch, because you can say it's going to be huge. And so you can be persuasive as a founder and just say here's all the evidence I had. DocSend raised our seed round before we publicly launched. So we raised our Series A before we had any notable revenue. So we decided to, do those things earlier rather than later. But on the other hand, launching early gives you more information on what is working or not working. So you can kind of get started actually scaling your business earlier. So there's just tough trade-offs to make for all of these decision points. And so, fundraising, unfortunately, is time as a founder you don't get back. You don't get credit for the time you spend fundraising. You just get credit for building your company. So fundraising is a necessity, but you kind of want to get it done as early as possible or as fast as possible, and kind of get back to building your company.
I know that you've mentioned that fundraising and sort of best practices are very case by case. Are there any anything that is more universal that you can sort of help someone walk away with, that they can say, listen, if you're fundraising, this is a best practice based on what I've seen, or there's a probability that if you do this, you're going to end up being more successful? Or is it just really on a case by case and you don't want to commit to any absolutes, which is also fine.
No. I could go through a whole bunch of stuff for you. We could spend a couple hours on.
I'm sure you could. So let's do a few. Let's do a few.
Okay, we'll do a few. The first is like people ask, like, do I need a pitch deck or not? And my answer is usually yes. If you're asking that question, yes. People who don't need a pitch deck have enough previous success and the relationships to just walk in and say, here's generally what I'm doing, give me money. And like, okay. And people also, for most people, yes, they're like, oh, can I create a video pitch? And I'm like, well, maybe, but like just the way it works, at least in Silicon Valley or kind of like professional, software investing, like venture capital, is like pitch decks allow investors to be very efficient running through things. And so it's like 3 to 4 minutes per view on average. And so they can just intake a lot of information about what you're doing. So yes, you're probably going to have to create a pitch deck. And then also, by the way, that pitch deck is so helpful when you have to go hire a bunch of people. It's also very helpful in forming like what your sales deck looks like if you're doing B2B or doing any sales. And it's just a really helpful document for what are you doing, like document, like, and then, you're going to iterate on that in the future. So create a deck and be thoughtful. It doesn't need to be the world's best designed thing. Also in the creation of that deck, keep it simple. The most common mistake I see is that people make what they're doing sound more complicated in hopes that it makes it sound smarter or more defensible. And it does not have that effect typically. One of the nice tests of this is like, can you take it to a friend who's not in tech, your parents, an aunt, uncle, and tell them what you're working on and see if they can like repeat it back to you. And even when you're asking like friends for feedback, give them your pitch, show them your deck, give them your elevator pitch, and then ask them like, how would you repeat this back to me? And if they have difficulty with that, that means you got to dumb it down more, because the best pitches seem like intuitive, make sense, and they might leave you with questions like, why hasn't that been done before? Or isn't that kind of like blah, blah, blah? And then you can answer and address those things. But if you start the pitch with, why is it differentiated? That gets in the way of like, what is it to begin with? And so a lot of founders, especially first-time founders, aren't comfortable dumbing down what they're doing to like that level of simplicity, which I think you kind of have to do in order to get across the point. There are other like best practices around like why now or why you, type of things. Like those aren't obvious questions. Like I see a lot of founders where they're like, well, I don't need to add a why now section or why now page. It's obvious that this is a thing that should be done today. And another thing to stress for founders is that nothing is obvious to investors. Like assume no knowledge on the part of an investor when they're reading your deck. So, like as you go through it, keep an eye out for like, start with the obvious stuff, like why are you uniquely suited for this? Why is this a thing that has to be done today? Why hasn't it done before? And there are also invariably going to be like holes in your pitch that about. So for DocSend, one of the holes in our pitch was like, why doesn't Google just go do this? Or why doesn't Dropbox go do this? And there wasn't a great answer. And for a lot of software, there's not a great answer as to why Google doesn't do it or some big other company. There's been a lot of research around innovator's dilemma. And if you've worked at a big company, it becomes a little bit more apparent, like why things just move real slowly. But in terms of like, pitching it and, how to represent that, for us, I was like, well, I went and talked to people and they're just not going to build it. So, for you as a founder, it's okay to leave some things unanswered. Like, don't over stress about them. If, the question is like, well, why doesn't Uber do this? It can't be so close to Uber that it's like, oh, they probably will do this. But if it's like, listen, they're focused on these things, there's a risk, but, I've talked to some friends there and I think we've got years in the future to do this. And some investors might say, no, like that's too risky. Other investors might be like, I believe you. And I think you've got a great head start on it and we'll back you. So again, you only need one yes. So instead of focusing too much time on like that particular hole in your deck, maybe put more effort into what is your go-to-market? How are you scrappy in the beginning? Or, hey, what's your hiring plan? Or like list all the engineers that you're going to recruit once you get the funding in the front door. So there are those things. I think another common one is like financials. If you're like a seed stage company, don't put financials in there. I think this was like a thing in like the 80s. Or maybe 90s or something, where it's like the business plan thing, and then you had to like have pro forma numbers and like, especially early on, like don't do that. It's like very rare that needs to be a thing. Like to the extent your business has like COGS or it's like a physical product, you need to demonstrate that you understand kind of like how those things work. But like, if you put financials in there, people will spend a lot of time reading them. And that's not necessarily what you want, because usually your financials aren't the bright spot for your startup, and anyone can make up math and make it look like a hockey stick. So I'd say, that's like a made up exercise, like not to be put in there.
Thanks for tuning in. If you found this valuable, don't forget to hit that subscribe button so you never miss an episode. And if you want to dive deeper into this conversation, check out the links in the description to watch the full episode. See you in the next one.